Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey everybody, welcome back to the Get Real Podcast. Ron Phillips here. Man, I'm coming in with some interesting news, I guess, today. I've been looking at the Home Affordability Monitor. The Atlanta Fed puts out one. I've talked about it on the show before, and another article that just came out from Citi Research. So I'm going to talk about both of those things. I want to start with the Citi Research piece because I have talked about interest rates on this show. I don't know how many times. It feels like every time I talk about them, that they're changing directions. So I'm going to take this opportunity to express to you what I've said before, but I want to make sure that it sinks in. I don't know what's going to happen with interest rates. Citi Research claims that interest rates are going to come down for a few reasons. And I'll get into those reasons in just a minute. But interest rates right now, they feel like they're crazy high, but they're not. And house prices have continued to go up. Actually, let's start with the Home Affordability Monitor. This might actually tie in a little bit better. Now, the Home Affordability Monitor is behind several months. It always is. So right now, the most updated information is from April of 2024. And but right now, the Home Affordability Index is 69.6%, with 100 being affordable, anything above that being very affordable. So, and to put that in perspective, back in 2007, right before the crash, in 2007, the home affordability got down to 74. The lowest point was 72%. So we are worse than we were at the worst time before the crash prior. Now, I'm not saying that to say that we're going to have a crash. Quite the contrary. I am saying that just to note just how unaffordable homes are right now. And here's the reason. If you actually go back in time to where, interest rates aren't 7%, where they're in the fives, home affordability goes up to 85%. Now, here's the crazy part. The median home price back then in 2022 was $345,000. Today, the median home price is $376,000. So even with the increase in interest rates, home prices have gone up. We have a massive supply and demand problem. And I don't think it's going to get fixed anytime soon because the banks and the builders both they're not cooperating. So there's not a ton of permits being pulled. Building is down, and we have already had over a decade of underperformance in the construction industry. So if you remember from several shows ago, and I talked about housing starts, we need about 1 million to 1.5 million new units every year, depending on who you ask. Let's just say 1 million, just to keep pace with population growth, just to keep pace. Okay. Well, we've been below that number for over a decade. So there's a built-in shortage of homes that we have to catch up on in order to meet the demand. And we're slowing down construction right now. And permits for 2025, like new homes actually hitting the ground in 2025, they're down, not up. Now, going back to the article from Citi, so we have increasing prices, we have increasing interest rates, which really affects affordability. And all of that said, Citi says that interest rates are going to come down. So, what is going to happen when interest rates come? Okay, if interest rates come down, what is going to happen to the price of homes? I'm going to leave you with that while I start talking about this article. So this is from Fortune. The bank cited fresh signs of a slowing economy for its view that the Fed will trim rates by 25 basis points, which is not that big of a deal, right? 25 basis points, not that big of a deal. But it goes on to say 8 times starting in September. So, and extending through July of 2025. So, starting in September, Citi is suggesting that the Fed is going to cut the rates 8 different times by a quarter of a point. That's 200 basis points. That's a lot. That puts rates down at 5, and depending on how you play the mortgage, sub 5. That's an insane cut in a very short amount of time. So benchmark rates are going to go from 5.25 down to 3.25. That's a lot, and it's in a short amount of time. Now, if you recall, before when interest rates went up, they went up incredibly fast like that. It was shocking to the system. Bringing them down that fast will also be shocking to the system. Okay, the economy has cooled off from its heady pace in 2023. Air quotes, with inflation resuming a slowdown after some unexpected stickiness, which it certainly wasn't unexpected to a lot of people, myself included. But the Institute for Supply Management Service Sector Gauge, which abruptly reversed into negative territory, and the monthly jobs report, which showed unemployment rising to 4.1%, have raised the risk of a sharper weakening of the economy and a faster pace of rate cuts. And then it goes on to say that Fed Chair Jerome Powell on Tuesday suggested the first rate cut will very likely come in September. So the Fed chair is actually openly stating that. Now, they didn't say 200 basis points. They said that the first rate cut will very likely come in September. Shocking, right before the election. Yeah, right. So a continued softening of activity will provoke cuts at each of the subsequent 7 Fed meetings in our base case, Citi predicts. So what's happening is that the jobs report is not going well. The economy is slowing. It looks like people are losing their jobs. Unemployment rate's going up above 4% now. And all of this is bringing in rate cuts so that they can kind of start to stimulate the economy so that we don't go into a recession. Now, I'll go back to my original question. What is going to happen if they actually cut the rates by 200 basis points in 6 months' time, or 6 or 8 months' time? House prices, folks, are going to go crazy. They are going to go crazy. And so I'm going to reiterate. Home prices have been going up, not at a crazy pace, but they've been going up or staying steady depending on the market that you're in. And you lower interest rates, all of the people who haven't been able to enter the market because they've been stuck in houses that have a 3.5% interest rate, all of a sudden, it's going to be affordable. It's going to seem affordable again to be able to go back out and get into the market. So those homes are going to come on the market. They're going to be listed. We still have a shortage. Those people are then going to need new homes to move into, and that's going to take more inventory off the market. And what we're going to see is supply and demand, kind of similar to back when we got done with COVID. We had all of this pent up demand. And then they opened the doors and allowed us to get out of the house, and prices went through the roof. I believe that's what's going to happen when and if they lower interest rates in that short of a period of time by that much. So we've talked about on the show before, like, what do you do? Well, right now, there are sellers out there who are giving pretty crazy incentives to buy properties, both in the investment space and in the retail space, owner-occupied space. Whether you're shopping for owner-occupied or you're shopping for investment property, I truly believe buying now is a better deal than buying next year when the rates come down. Because you can buy a property at a lower price than it's going to be next year. And with the incentives, you can actually lock in some reduction in the price, even compared to what the actual prices are today. And then next year, if rates come down, you can just refinance. And my gosh, if you can refinance at 2% lower, that's incredible. That's incredible. Just to give you guys an idea of what that means. Houses today, well, this is back in April again, from the Home Affordability Index. That $376,000 mortgage is $2,250. But back when the prices were $345,000 at just under 5%, that's a $1,500 mortgage. It's massive difference. Massive difference. And the price point's only, what is that? $30,000 difference? It's not that much difference in price, but the interest rate is substantial. So if you can lock in a lower price point now, and then you have the ability to refinance next year, I believe people will be better off. Just my opinion. If you wait until prices start going skyrocketing, and here's the other thing. There's going to be people who are going to be out there, and there's going to be such a frenzy of people wanting to buy properties that there's going to be this bid scenario again that we used to have, which right now is really not in the market. It's in some price bands of the market, but for the most part, it's not there. You can actually shop now without having that. So if you can find a property that, if it's an investment property that cash flows, that works now, and you can get a ton of incentives to actually purchase that property, next year refinance, your cash flow is going to be better. You're already going to have locked in a rate or a price point that's going to be lower than next year. Your equity is going to go up. Everything is going to be better, in my opinion, next year. If a property is purchased this year. So that's my suggestion. And that's what's going on in the marketplace right now. I'll believe it when I see it, folks. But the Fed chair this time, not just one of the large banks, but a combination of one of the large banks and the Fed chair, has said that rate cuts are coming. Looks like they're going to start in September. So I'm going to put all that in your brain again. And if you're interested in looking at investment properties, you can reach out, info@rpcinvest.com. If you have a topic that you would like us to discuss on the show, then you can also reach out and let us know. If you haven't already, we would love it if you would give us a review and just make it an honest one. But a written review helps us out a ton. Don't keep us a secret. And until next week, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.